Welcome back, my awesome people. In today's episode, I'll be highlighting the two most popular strategies of investing, which are value investing and growth investing, and which strategy is better suited for your investing goals. Growth and value are two fundamental approaches in stock investing. Growth investors seek companies that offer strong earnings growth, while value investors seek stocks that appear to be undervalued in the marketplace. Because the two styles complement each other, they can help add diversity to your portfolio when used together. The decision to invest in growth versus value stocks is ultimately left to an individual investor's preference, as well as their personal risk tolerance, investment goals, and time horizon. History shows us that growth stocks in general have the potential to perform better when interest rates are falling and company earnings are rising. However, they may also be the first to be punished when the economy is cooling. And value stocks may do well early in an economic recovery, but are typically more likely to lag in a bull market. Of course, neither outlook is always correct, but some stocks can be classified as a blend of these two categories, where they are considered to be undervalued, but also have some potential to go above and beyond. So what is the difference between these two strategies? Well, value investors are on the hunt for hidden gems in the market. Value investors buy stocks they believe are underpriced, either within a specific industry or the market more broadly, betting that the price will rebound once others catch on. Generally speaking, these stocks have low price to earnings and high dividend yields. Value stocks are usually larger, more well-established companies that are trading below the price that analysts feel the stock is worth. For example, the book value of a company's stock may be $25 a share based on the number of shares outstanding divided by the company's capitalization. Therefore, if it is trading for $20 a share at the moment, then many analysts would consider this to be a good value play. Like Warren Buffett. Stocks can be undervalued for many reasons. In some cases, public perception will push the price down, such as if a major figure in the company is caught in a scandal or the company is doing something unethical. But if the company's financials are still relatively solid, then value seekers may see this as an ideal entry point because they figure that the public will soon forget about whatever happened and the price will come rising back again. Value stocks are considered to have a lower level of risk and volatility associated with them because they are usually found among larger and well-established companies. Additionally, value stocks don't emphasize growth. So even if the stock doesn't appreciate as high as growth stocks, investors typically benefit from the dividend payments. Value stocks have more limited upside potential and therefore can be safer investments than growth stocks. Growth investors, however, often chase the market's high flyers. Growth investors are attracted to companies that are expected to grow faster than the rest. As growth is the priority, companies reinvest earnings in themselves in order to expand in the form of new workers, equipment, and acquisitions. Don't expect dividends from growth companies. For them, it's go big or go home. Growth companies offer higher upside potential and therefore are inherently riskier. There's no guarantee a company's investments in growth will successfully lead to profits. Growth stocks experience stock price swings in greater magnitude, so they may be best suited for risk-tolerant investors with a longer time horizon. It's essentially doubling down on a stock. Investors bet a stock that's already demonstrated better than average growth will continue to do so, making it attractive for investment. But by buying at an already high price, the risk is that something unforeseen could cause the stock's price to fall. Growth stock companies are typically the leaders in their industries. Their stocks have above average price to earning ratios and may pay little to no dividends. And instead of paying out dividends, they will instead reinvest their earnings back into the company to expand. Whereas value investors look for companies that have already earn their stripes and have a stock price that's lower than it should be. Value stocks tend to outperform during bear markets and economic recessions, while growth stocks tend to excel during bull markets or periods of economic expansion. Same desired destination, just different ways of getting there. So Jacob Rant, what kind of investor are you? Are you a growth investor or a value investor? Well, my awesome people, I am primarily a value investor. My goal is to eventually be able to live off the passive income provided through dividends from my investments. And because of that, I am a value investor. I like to buy companies that have a solid dividend yield, are recognizable brands that have a global reach, and have shareholders in mind. Growth stocks include Apple, Amazon, and Google, as they do not pay a solid dividend. And value stocks include Coca-Cola, Iron Mountain, and AT&T. And these value stocks are currently weathering this recession as they are still paying dividends, even though the share prices have taken a massive hit. So why buy a growth stock in the hopes that it grows and not get paid when you can buy value stocks and get paid while you ride this recession wave? Remember, value investing is about finding diamonds in the rough, companies whose stock prices don't necessarily reflect their fundamental worth. As time goes on, the market will properly recognize the company's value and the price will rise. And remember, my awesome people, just like all the information I mentioned in my videos, assess your risk appetite, always diversify, and please do your own due diligence because I am just a clown on YouTube. Stay ranting.